An individual may be looking to protect their assets from a variety of financial predators. For example, a business owner might be looking to hold family shares on trust to protect them from a child entering into a marriage that doesn't last. An investor might want to hold property or other assets in a structure such that those with too much time on their hands simply cannot pry into their business on Companies House. A family might also want to hold their assets through a structure to shelter their wealth from inheritance tax. A property developer might look to arrange his or her ventures in a way such that legal claims arising in respect of historic developments do not pollute current and future ones. These are all examples of asset protection. In modern times, with a movement towards transparency and a shift in focus from income taxes to wealth taxes, some of these issues are harder than others. As with all tax and financial planning, there is no one size fits all, so one must take into account one's personal and commercial objectives and work from there. Traditionally, trusts have been used extensively for these purposes. Of course, the press would like us all to believe that a trust is some kind of magic financial bucket, and once you drop the assets into that magic bucket, it's free of all taxes. Of course, this is far from the truth. However, instead, it's our experience that trusts are almost always used as a means of protecting assets, for making a gift, including perhaps shares in a family business, but adding strings to that gift. For example, there's comfort in giving someone the dividends on the shares, but they're not prepared to allow them to have the underlying capital in their own name. Changes to trusts over a decade ago made them unsuitable in many scenarios. As such, alternative structures have arisen in their place. Things such as investment companies, family partnerships, overseas pension schemes and foundations. The type of structure will depend on what you're trying to achieve and the long-term ambitions for the structure. Of course, one of these structures might be able to meet some or all of the objectives. However, there are a number of tax implications of transferring assets to structures. Generally, one will need to manage any capital gains tax and IHT implications in particular. The ongoing tax position will largely depend not only on the structure, but the type of assets owned and their location. One needs to carefully consider to who and by what means funds might ultimately be paid, as this will also drive the tax consequences. This is a complex area and one needs to take legal advice as well as tax advice. However, in the first instance, please do not hesitate to get in touch and we'll discuss your requirements.